Another quarter has come and gone, and now it's time to take a look at the numbers from the U.S. apartment market in first quarter 2012. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons, and I'm with Greg Willett, the VP for Research Analysis at MPF Research. And Greg, before we take a look at the stats, set the stage for us a little bit. What were we expecting going into first quarter?
Well, when we predicted 2012 at the end of last year, what we really said was that revenue growth would this year essentially look the same as it did last year. But as we look at some of the market influences, the first quarter employment numbers actually came in better than expected. So as we were looking at the results for first quarter on occupancy and rent growth, what we were really checking to see is, did those better employment numbers translate to anything that says we should raise the targets for 2012?
Okay, so let's look at the numbers, and then we'll try to answer that question of should the target be moved. And before we get into that, I want to point out that we've changed our baseline for the U.S. a little bit. We've upped our U.S. coverage from 64 markets to 100 markets. So today we're introducing the MPF 100, and we've also revised our historical data to this point so that we have apples-to-apples comparisons. But I'll point out that it really doesn't change the story at all, because most of these markets, or all of these markets that we're adding, are smaller markets compared to the 64 we had earlier. So let's jump in and look at the supply, demand, and occupancy numbers. Apartment demand for the MPF 100 came in at 39,900 units compared to new supply at 13,600 units. And at those supply and demand levels, occupancy ticked up 0.2 percentage points, up to 94.9% for the quarter. And that means year-over-year occupancy growth came in at 1.2 points. Very solid.
Very solid numbers. And let me talk about what happened on the rent side of things. For the quarter, effective rent growth for new leases came in at 0.9%. Another really solid number, although I'll point out that for that one, it's a little bit less than the first quarter 2011 number. So that means that the annual rent change has cooled off a tiny bit. What we see is the number now is at 4.6%. Really good in the big picture and long-term trend, but off a tiny bit from where we had been.
Okay, so if I recap then, I think what I'm hearing then is that the 1Q stats largely matched your expectations set going into this year, but the job growth didn't necessarily caused us to want to revise up our expectation for 2012.
Yeah, we do have the expectation for 2012 really where we already had it established. And one thing as we look at these numbers for first quarter, there's a lot of noise in them compared to what we've seen in previous quarters. And some metros did particularly well, others not so much. And when you dig into the underlying influences, there's not a lot that really explains why it was a little bit of a hit and miss situation. And as I talk to individual operators out there, they're really telling that same sort of story, that the numbers look great at most properties, but there can be other properties even within the same metro where suddenly you're off a little bit compared to expectations. And I think that really comes down to we're hitting that market stabilization point. And when I say market stabilization, I'm not saying that revenues are flat. I'm saying that revenues are going up now this year at about the same pace that they did last year, and you just get a little bit more up and down for individual properties whenever you reach that point in the cycle. So usually we tell clients, pay attention to every single detail on what's going on. To some degree, our advice changes there. As we look at this year, we're saying look at the big picture and don't overreact to a tiny blip in an individual property performance and adjust what was already a good strategy for you.
Okay. And speaking of maybe overreactions, let's talk about supply a little bit. We've got a lot of questions from the media and even some worry from people in the industry that we're hearing at industry events about new construction. What's your take on construction in 1Q?
Well, throughout last year, we kept saying that there were a lot of product announcements, but that wasn't translating to product that was really coming out of the ground yet. It was taking a long time to get those units physically under construction. That bump that we knew was coming at some point, really to some degree, did arrive in first quarter. The number of units physically under construction now across that MPF 100 market series is up to 139,000 units, more than we've seen over the past few years. But it's important to realize the past couple years was really, really low numbers. And the comparison point we need to be watching is 300,000 units. And we actually thought of that as fairly restrained at the time if you look back in even longer term history. So right now we're coming up on halfway to the normal level. It'll keep accelerating as we go through the course of the year, but even by the end of the year, I would say the construction volume is maybe 2/3 to 3/4 of the way back to normal. So I'm not too concerned right now.
No cause for alarm, yeah. Okay, so next week we'll start delving into results from individual metros. And as Greg pointed out, we have seen some notable shifts in some metros, more notable than perhaps we've seen in the past few quarters. We're going to highlight some of those. I'll give you a sneak peek. You're going to like what we have to say about the Pacific Northwest after some pretty rough numbers in fourth quarter, some good results in first quarter. Also stronger than expected numbers in Charlotte, Phoenix, and Miami. But of course, there were some disappointments to San Diego, Atlanta, and one that maybe might surprise some of you, Austin.
Austin,
yeah, believe it or not. And we'll break down all those markets for you, and we'll be able to do a little more granularity than we have in the past. In addition to expanding our core U.S. coverage to 100 markets, we've also revised our submarkets from nearly all of our metros, and that means a lot more submarkets than we had before, and that means we'll be able to break down our numbers in a lot more granularity than we have in the past. We all like granularity. That's good. So time to close it out. So until next time, we start doing individual metros. He's Greg Willett. I'm Jay Parsons. Thank you for watching Apart Market Dynamics.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.